We are now ready to explore our third method for recording depreciation expense with a method known as the units of production. Okay. So with this method, it is based upon the actual usage of the asset. Let's go through it. So this van that we purchased had the capacity to be driven a total of 100,000 miles. So recall that the cost of the asset was 24,000. Salvage value was 4,000, which gave us a depreciable cost of 20,000. And we're saying the van can be driven for a total of 100,000 miles. So now every time I drive this van 1 mile, I'm going to expense at a rate of 20 cents per mile driven. So with the unit of production, your first step to determine what would be your rate per activity. In this case, it's per mile. We're going to expense the cost of this van at a rate of 20 cents per mile that is driven. So now you're going to take the actual miles driven each year times the rate to get the amount of your depreciation expense. So in year one, we drove the van 40,000 miles. So 40,000 times 0.2 would give you 8,000. We drove the van half at 20,000 miles in year two. Expense was 4,000. We drove the van 30,000 miles in year three. The expense was 6,000. Now keep in mind that you still have to keep track of how much you expense so far because you cannot go beyond your depreciable cost of 20,000. So at the end of year three, we've expensed so far a total of $18,000. So although in year four, we drove the van 15,000 miles, which would give us 3,000 as expense, you cannot use that 3,000 because you only have 2,000 remaining in depreciable costs. Therefore, in year four, the expense recognized will only equal $2,000. No matter what method you use, straight line, double declining, unit production, you can never, ever, ever, ever go beyond the depreciable cost of that asset. Okay? So, what you would notice is that, again, here we're showing the expense each year, the cumulative count, and again, this number here cannot exceed your depreciable cost, which in this case was the $20,000. This is showing the income that was received. Again, the money spent for the purchase, the stocks being issued, and the ending cash balance for years 1 through 4. Now, no matter which method you choose, it will give you the same results over time. It's just that notice you'll have a different amount depending upon if you use straight line, double decline, and unit production each year. But over that 4 year period, the total amount expense under all three methods will still end up being $20,000. Okay? So we've talked about the acquisition of these assets. We've talked about the uses of those assets. Now we'll discuss the gains or losses on disposal of these long-term operational assets. Okay? So remember that we bought the same van that we bought for $24,000. Okay? Now we're in year five. At the end of year four, the book value is 4,000. Remember, book value is original cost minus cumulative depreciation. But we sold this van for 4,500. So now you're comparing the actual selling price, 4,500, against the book value. If your selling price is higher than book value, you record a gain for the difference. But if the selling price is lower than a book value, you'll recognize a loss for the difference. In our example, we sold it for 4,500 it had a book value of 4,000. Because your selling price is higher, you record a gain in the amount of $500. So now the cash account will increase by 4,500. Because you sold the van, the asset account would decrease by 4,000. Retained earnings will increase by 500 because of the gain. So the gain on the income statement is similar to revenue. So the gain is shown for 500, and we're going to show net income from that gain. On your statement of cash flow, because you receive cash at 4,500 from the sale of a long-term asset that qualifies as an investing activity. Okay, so here is a comparison of all three methods. You see with the straight line method, it's equal. It's 5,000 each year. With double declining, you expense a greater amount in assets earlier years and a smaller amount as the asset becomes older. Unit of production is based upon the use of the asset, which can go up and down. But again, you notice that with all three methods, at the end of 4 years, the total amount of expense still equals that $20,000. Okay? Next, revising estimates and how they affect the financial statements. What we're saying here is that in our formula for depreciation, you have cost, salvage value, and you have useful life. Well, two of those are estimations. Those two being your salvage value and your useful life. And those estimates sometimes are going to be changed based upon some type of new development. For example, we purchased a machine on the 1st of January for $50,000. The machine has a useful life of 8 years and a salvage value of $3,000. If using the straight line method, you would take your cost minus your salvage value, so 47,000 are the depreciable costs, divide that by 8 years, we're going to expense every year $5,875. That makes sense to you? Okay. But here's a change. At the beginning of year 5, the amount that we've accumulated will be 23,500. That's 5,875 per year times 4 years. And the book value will be 26,500. So remember that book value is original cost less the accumulated depreciation. So the book value at the beginning of year 5 is 20,500. Now we made a change. We revised the useful life to 14 years rather than 8 years. So remember, initially we said the machine could be used for 8 years, but now we're saying the machine can be used for 10 years. Well, you don't go back and change previous years. You're going to make the change in the current year and going forward. So now that 14 years is the asset's total useful life. Okay? We've already had the machine for 4 years. Therefore, there's 10 years remaining on the asset's useful life. Say it again. I will. So 14 years is the asset's total expected useful life. However, you've already had the asset for 4 years. We're year 5 now. Therefore, there's 10 years remaining on the asset's useful life. So in our calculations, we'll take our current book value, 26,500, minus the salvage value of 3,000, divide that by 10 years, remaining useful life. So now we're going to expense the asset every year, $2,350. Okay? Or we could revise our salvage value. So in this example, we're keeping the 8 years, but the salvage value will be revised from 3,000 up to 6,000. So again, remember that the book value at the beginning of year 5 is 20,500. So you always take your book value at the beginning of the year of that revision. That was 26,500. Subtract out your new salvage value, which is 6,000. So 20,500 is our remaining depreciable cost. Divide that by the remaining useful life of 4 years. So now you're going to expense each year $5,125. So when there's a revision, you're going to determine the beginning book value at the year of the revision, then put in your new numbers to record your depreciation expense. Okay? So now we're just taking a look at how the costs are going to be expensed. So in this situation, what do we have here? We have expense of $500. What's that expense for? I'm gonna be there. It is. Okay, I'm like, I don't know, but here it is. Assume we spent $5 for routine lubrication and minor parts on the machinery. So those costs you're going to expense right away. So your cash account would decrease by 500. So does retained earning. Expenses increase by 500. That's shown as operating activity on your statement of cash flow. Okay? So maintenance costs are going to be expensed as they incur or take place. So for example, if we're getting a routine lubrication, oil change, getting our tires rotated, you're going to expense those type of costs as they incur or take place. In contrast, there's something called capital expenditures. Capital expenditures. That's when we spend a substantial amount to improve the quality of life of an asset or extend the useful life of an asset. So, for example, if you put a new engine into your automobile, that would be a capital expenditure because it is going to extend the life of that asset. Or if we add a new wing to our manufacturing plant, that would be a capital expenditure because it's going to improve the quality or usefulness of that actual asset. Okay? When that happens, those type of costs you're not going to expense right away, but they're going to be included or added to the actual cost of that asset. For example, we made a major expenditure to our machine and a cost of 4,000 that would improve the capacity of that machine. So this cost you're not going to expense right away. That 4,000 goes into the actual machine account to increase its value. Because you made a payment, the cash account decreased by $4,000. Statement of cash flow, you will have an outflow of 4,000 as an investing activity. But notice that you did not record an expense for this transaction. Now, over time, even those major expenditures will become an expense. So let's go through our calculation again. So here, remember that the machine was bought for $50,000. Salvage value was $3,000. We had expense through year 4, $23,500. So $26,500 was the book value at the end of year 4. But we just spent $4,000 in year 5. So now that $4,000 is added to the original cost of $50,000, so $54,000 will be the total cost of the machine. The current book value is $30,500. We're adding that 4,000 to that 26,500 to get the current book value of that machine. So now, doing our calculations, we'll take our new book value minus salvage value divided by the remaining useful life to get them out of our annual depreciation expense. Okay? So stay tuned for the conclusion of our Chapter 6 video lecture. Bye bye.